Hi, I'm Rohan Fernando, and this is my Capstone project for Management 490 AI finance application. The application I built is called Integrated Finance Application, and it implements Pattern a value based portfolio. The core idea is simple but powerful. Before you even think about optimizing a portfolio, you should ask whether the stocks you're considering are worth owning in the first place. So, the pipeline I built answers that question in three sequential steps. First, it runs a DCF valuation screen to filter out overvalued stocks. Second, it takes only the undervalued stocks and runs Markowitz portfolio optimization to maximize the Sharpe ratio. Third, it runs a new sentiment overlay using an LP to flag any holdings with negative sentiment risk. The key thing I want to highlight is that these three components aren't independent, they're connected. The output of step 1 feeds directly into step 2, and step two's output feeds into step 3. I'll demonstrate that cross component integration throughout this walkthrough. Let me open the app. As you can see, this is the dashboard. The app is built as a Streamlit application running locally. The title, as you can see here, is Integrated Finance Application. And as you can see, the tagline says it combines DCF valuation, Markowitz optimization, and new sentiment analysis into a cohesive pipeline, which is exactly what it's supposed to do. On the left sidebar, you'll see the global parameters panel. This is important because these parameters don't affect just one step, they flow throughout the entire system. Under these parameters, I have three sliders. One is the WACC or the discount rate, currently set to 5%. This is a rate I use to discount future cash flows back to present value. You can also see information through if you hover over the question mark right here. The projected growth rate that is set to 10% is the assumed annual growth rate for the cash flows. Third is the required margin of safety, which is 15% right here. This means that the stock only passes the valuation screen if it's trading at least 15% below its intrinsic value. Under optimization parameters, the risk-free rate is at 0.06, which is used in the Sharpe ratio calculation. Historical look back at one 1 year, and that's how far we will pull price history for the optimizer. Third is the max weight per asset that's set to 0.35. That's the default setting, and the portfolio constraint that prevents overconcentration in any single stock. The third one is a little more interesting. It's the sentiment parameters, which has a news look back of the companies we will be analyzing, and I put it at a month, that's 30 days. The critical design decision here is that all of these sliders are global. When I change the WACC, it doesn't affect just the DCF. It's supposed to change with stocks past the valuation screen, which changes the universe that are fed into the optimizer. It also changes the final portfolio that the sentiment overlay analyzes, and I'll demonstrate that reactivity in a moment. So as you can see here, I put a couple of stock tickers, and these are pretty famous: Apple, Microsoft, Tesla, and so on. If we press run, it would do the analysis for us given these parameters. So these eight stocks span technology, healthcare, energy, and consumer sectors. Diversifying the input universe is important because the optimizer needs variance in return profiles to find meaningful trade offs on the efficient frontier. Once I've clicked this, as you can see, it does step one. Step one is the DC evaluation screen. It shows us the current price, which is the live market price pulled from the financial data API. Intrinsic value is what my DCF model calculates the stock is actually worth. The margin of safety price is the intrinsic value multiplied by 1 minus the margin of safety. So with a 15% margin of safety, the stock has to be trading at 85% or less of the intrinsic value to pass. Looking at the results, Apple is currently priced at 267, 270. The intrinsic value of 401.92 and a margin of safety price at 341.63. It's trading well below its intrinsic value, so it's undervalued. So it passes. Microsoft is currently trading at 429.25, the intrinsic value at 740.21, and the margin of price safety in price is 629.18, which is roughly undervalued. So hence it also passes. When we talk about Tesla, this is an interesting one. The current price is 376 and the intrinsic value is 49.8, whereas the margin of safety is 42.32. It is trading at roughly 7.6 times what my model thinks it's worth. It gets flagged as overvalued and is filtered out of the pipeline. J&J also passes as undervalued. Similarly, Nvidia also gets flagged as overvalued in this, given its 15% margin of safety buffer, and it is flagged. Hence, it is thrown out. Like that, you can see a couple which have passed. The only ones which haven't passed are Tesla and Nvidia. So this is the whole point of the first step. We don't want to optimize a portfolio that includes stocks that are trading at irrational premiums and are being overvalued. So why does Tesla get such a low intrinsic value? Because DCF is fundamentally about cash flows. Tesla's current cash generation, discounted at 5% WACC and a 10% growth rate, doesn't support the high price. You might disagree with that. Reasonable people generally do, which is exactly why we have the sensitivity analysis. So for Apple, you can see how the intrinsic value changes across the grid of WACC rates, 6 to 12%, and growth rates, which are 2 to 10%. You can see the highlighted cells right here, WACC 6%, 8% growth, gives us $274.42, which is right around the current price. This tells me Apple's current price is actually consistent with an assumption of moderate growth and slightly higher discount rate. The takeaway here would be that the valuation is sensitive to assumptions, and this table helps me understand the range of outcomes. At higher WACCs like 10 to 12%, intrinsic values drop significantly. That's because future cash flows get discounted more heavily. At lower WACCs with higher growth, the intrinsic value gets very large. This is textbook discounted cash flow behavior. So, step two takes the six stocks that have passed: Apple, Microsoft, J&J, XOM, Meta, and Google, and runs the Markowitz mean variance optimization and finds the portfolio that maximizes the Sharpe ratio. You can see the expected annual return at 52.9, the portfolio volatility at 11.76%, and a Sharpe ratio of 3.93. A Sharpe ratio of 3.99 is extremely high. The app actually notes this in the limitation screen, and I want to be transparent about it. This is likely because the 1 year historical look back captures an unusually strong return period for tech stocks in particular. With a longer look back window of 3 to 5 years, you'd get more conservative estimates that better reflect a full market cycle. The current number reflects recency bias in a return estimate. You can see the optimal weights right here. The optimal portfolio is right here. The J&J would definitely be the highest, the single largest position, capped at around 40%. And Microsoft at 31.8%. As you can see right here, 31.6, and then Google at 27.7, and Meta at 4, at around 4, then XOM at around 1.3. which is so notice that Apple gets zero weight even though it passed the DCF screen. This isn't an error. The optimizer found that Apple's risk return profile is dominated by other assets. In the efficient frontier chart, you can see Apple sitting out in the middle with relatively high volatility. The optimizer prefers assets that contribute more return per unit of risk. You can see the efficient frontier here, right here, the curve. It shows the set of portfolios that maximize expected return for each level of risk. Individual assets are plotted as dots. The green star is our optimal portfolio. Notice how it sits on the frontier, which means the optimization is working correctly. Google being on the upper side of the asset plot, high return, relatively lower volatility compared to Meta, Microsoft, and J&J, which are more conservative. This explains why these three dominate the weights. The optimizer is subject to constraint, I said. No single asset can exceed 35% of the portfolio, and all weights must be non-negative, that are long only. If I loosen the max weight constraint to say 50%, you'd see J&J's weight increase significantly since the optimizer wants to maximize J&J's contribution. Step 3 analyzes sentiment for the five stocks that actually receive non-zero portfolio weights. There's no point analyzing Apple here since the optimizer gave it zero weights. The app fetches recent news headlines using the News API and scores each headline using Vader, which is a valence aware dictionary and sentiments reasoner, which is a rule based NLP sentiment model specifically designed for social media and news text. Vader produces a compound score between -1 and +1, which is extremely negative and extremely positive. As you can see, all of them got a positive score except Microsoft, which got a roughly neutral score. That means no significant sentiment risk warnings for all these major holdings, which is a green flag. And it would basically mean that the sentiments don't contradict our fundamental position. As you can see at the bar chart, it will help us visualize these scores. Microsoft has a neutral sentiment at around zero point 0.1, and you can see Google has the highest positive in our list. The sentiment breakdown chart also visualizes these as actual headlines so that it gives us a transparent outlook, and we can also audit which articles drove the sentiment score, which we are trying to analyze here. One limitation I wanted to acknowledge is that Vader is a lexicon based, not context aware. A headline like Microsoft stock falls despite strong earnings might get a mixed or negative score because of falls. Even though the underlying news is good, a large language model would interpret that more accurately. That said, Vader is fast, free, and works well in aggregate across 10 plus articles. This is our cross component summary, and we can also see essentially what our app has done for us. So by adjusting the discount rate to 5% and the margin of safety to 15%, the DCF valuation screen to 6 out of 8 stocks is undervalued. This newly filtered universe was automatically piped into the optimizer, which instantly calculated a 5 asset portfolio, maximizing the Sharpe ratio to 3.99. Finally, the sentiment overlay reacted to the new portfolio by fetching 50 recent headlines, specifically targeting the optimal holding, scanning for NLP risk flags. This text is generated dynamically. It reflects the actual parameter values and results from this run. Let me also demonstrate the reactivity of our parameters. Now, if I were to say this, the WACC or the discount rate at 8%, let us see once I rerun it. What should happen is that future cash flows would now be worth less, so intrinsic values would fall. As you can see here, only Google passed the entire test given our high discount rate. But for it to move towards an optimizer, we need at least two stocks to pass our test initially. Let us move it to 0.07, which is a 7% discount rate. Now we can see two. Meta and Google are both undervalued by our metrics. While that processes, I want to briefly address AI usage as required by the course. I use Claude and ChatGPT as my primary AI coding collaborators. I use a driver framework specifically to define, implement, and evolve stages to structure my AI interactions. For the DCF engine, I wrote the financial logic myself based on what we covered in class. For the Markowitz optimizer, I use SciPy's minimize function. I use ChatGPT to help me set up the optimization constraints correctly. And for the waiter sentiment pipeline, I independently researched the NLTX waiter documentation and used Claude to help integrate the news API call and handle rate limiting edge cases. Where AI helped me the most was debugging data type mismatches and structuring how Streamlit sidebar parameter flows, where I had to exercise independent judgment, which means choosing what counts as pass in the valuation screen and calibrating the margin of safety threshold. All AI usage is documented in the README and driver reflection. So no financial model is complete without acknowledging its limitations, and I want to be genuine here. DCF limitations would be the intrinsic value are highly sensitive to growth rate assumptions. A 10% perpetual growth rate is aggressive for mature companies. For more rigorous analysis, you'd want to use a two-stage model, which is highest growth for years 1 to 5 and lower terminal growth rate thereafter. And pull growth rates estimates from analyst consensus rather than a single slider. The optimizer limitations would be using 1 year of historical return introduces significant recency bias. The Sharpe ratio of 3.99 is not realistic as a forward looking estimate. So it would be more wise to have a longer look back period. How a professional would use this is it essentially is a screening and ideation tool, not a trading platform. A portfolio manager might use step one to generate a watch list of undervalued names. Step two, to explore how those names fit together from a risk return standpoint. And step three, as a quick sanity check before taking a position. Every output would be a starting point for deeper research and not a final answer. To summarize, I built an end to end integrated finance application that combines DCF valuation, Markowitz optimization, and NLP sentiment analysis into a single reactive pipeline. The cross-component integration means that changing a single assumption like the discount rate flows through the final portfolio and sentiment output automatically. I'm proud of what this demonstrates, not that I can just get the tools working, but that I understand why each component makes the decisions it does, where the model breaks down, and how a practitioner would responsibly use something like this. Thank you.